America just put the world on notice, and the oil market just told you exactly what it thinks that means. The United States military is not preparing for a single strike, not a one-night precision raid designed to send a message and de-escalate before markets open Monday morning. The operational planning now circulating through CENTCOM, the munitions pre-positioning happening across bases from Diego Garcia to Udeid to the USS Gerald R, Ford's flight deck, the B-2 Spirit stealth bomber deployments being tracked by aviation monitoring services. All of it points to one assessment that Pentagon planners are no longer bothering to hide. This is preparation for weeks of sustained strikes, a campaign, not a statement. A systematic, methodical, target-by-target degradation operation designed to fundamentally alter the military balance in the Persian Gulf theater over a period measured not in hours but in weeks. And oil just responded the way oil always responds, when someone with credibility tells the market that the world's most critical energy supply corridor is about to spend several weeks inside an active war zone. It rallied, massively, continuously, with the kind of momentum that technical analysts call a breakout, and fundamental analysts call a pricing of existential supply risk. Brent crude is not spiking on speculation, it is repricing on assessment. The assessment of every physical oil trader, every refinery procurement desk, every national strategic reserve manager on Earth, simultaneously concluding that the Persian Gulf supply they have been counting on for their forward planning may not arrive on the schedule, their models assumed. Here is why weeks matters more than days in ways that the financial system has not yet fully priced. A single night of American strikes, the 1986 Libya raid, the 1998 Desert Fox operation, the 2020 Soleimani strike, generates a sharp market spike followed by rapid normalization as the scope becomes clear and the worst-case scenarios are ruled out. Markets are extraordinarily good at pricing discrete, bounded events. What markets are structurally terrible at pricing is sustained uncertainty, the condition where the worst case cannot be ruled out for an extended period because the operation generating the uncertainty has not concluded. Weeks of strikes means weeks of sustained uncertainty over Persian Gulf supply, and weeks of sustained uncertainty over Persian Gulf supply means the oil rally does not spike and normalize. It grinds higher with every passing day that the operation continues, and every Iranian response that escalates the stakes beyond the level the previous day's price already reflected. The world's biggest oil lifeline is not burning yet, but it is standing directly inside the blast radius of a campaign that has just begun. And the financial consequences of what happens in those weeks will reshape the global economic landscape in ways that will still be visible a decade from now. Let's establish the operational picture with the precision it demands, because the specific details of what America is preparing reveal the financial targets that the military campaign will inevitably hit, regardless of its intended military objectives. The B-2 Spirit strategic stealth bomber, the most expensive combat aircraft ever built at $2.1 billion per airframe, has been deployed to Diego Garcia, the British Indian Ocean Territory base that serves as America's primary staging platform for sustained Persian Gulf strike operations. B-2s don't deploy to Diego Garcia for one-night operations. The logistics footprint, the precision munitions stockpiling, the maintenance crews, the mission planning infrastructure required to operate B-2s from Diego Garcia is a weeks-long commitment that cannot be assembled and disassembled for a single strike. When B-2s are at Diego Garcia, a sustained campaign has already been decided. Everything else is sequencing. The target set for a weeks-long Iranian strike campaign goes far beyond the nuclear facilities that official messaging has focused on. Iran's air defense network, the S-300 batteries, the Bavar 373 indigenous systems, the Khordad-15 medium-range interceptors, must be systematically degraded before sustained strike operations can be conducted without prohibitive aircraft loss rates. Degrading Iran's air defense network is itself a multi-week operation requiring hundreds of strike sorties against distributed, hardened, mobile targets across a country of 636,000 square miles. Then the ballistic missile infrastructure, the launch sites, the production facilities, the underground storage complexes that Iran has spent 20 years hardening against exactly this scenario, requires sustained attention, because every day those facilities remain functional represents another day Iran can conduct retaliatory strikes against Gulf energy infrastructure. Then the naval assets, the fast attack boats, the submarine fleet, the anti-ship missile batteries along the Gulf Coast that threaten Hormuz transit must be addressed before the campaign can be considered to have achieved its strategic objectives. This target sequence has a financial shadow that mirrors it exactly. Every day of strikes against Iranian air defense generates Iranian pressure to use its retaliatory capabilities before they are degraded. Every day that Iranian ballistic missile facilities remain functional is another day that Saudi Aramco's Abqaiq processing facility, handling 7% of global daily oil supply, is a live target. Every day that Iranian naval assets remain operational is another day that the 21 million barrels transiting Hormuz face interdiction risk. The military campaign and the oil supply disruption are not sequential events where one follows the other. They are simultaneous processes where the military operation actively generates the supply disruption risk that is driving the oil rally in real time. Now examine the Strategic Petroleum Reserve position that America brings to this confrontation. The SPR currently holds approximately 370 million barrels, its lowest level since 1983, after the Biden administration released 180 million barrels between 2022 and 2023 to manage gasoline prices during the post-Ukraine energy shock. At 21 million barrels of daily Hormuz flow, 370 million barrels of SPR covers approximately 17 days of complete Hormuz closure before the reserve is exhausted. 17 days. Against a military campaign planned for weeks, the financial vulnerability this creates is not subtle. The primary American tool for managing oil price spikes during military operations in the Gulf, the SPR release has been pre-spent managing a previous crisis. The ammunition is gone, and the engagement has just begun. The mathematics of this vulnerability are not lost on oil traders. Brent at $90 before the campaign started. Brent pricing in a sustained weeks-long operation with a depleted SPR and an active Iranian retaliatory threat against Gulf infrastructure. The conservative price target among physical traders is $120 within 30 days. The less conservative target, the one that incorporates an Iranian decision to mine Hormuz as a retaliatory response to sustained American strikes, is $160 to $180. And at $160 oil sustained for more than 30 days, the mathematical consequences for the global economy are not recessionary. They are deflationary collapse followed by stagflationary spiral, the specific combination of economic conditions that central banks have no effective tool to address simultaneously. The pattern of a dominant empire launching a sustained military campaign against a resource-rich adversary at the precise moment of maximum financial vulnerability, when the empire's fiscal position is most constrained, its strategic reserves most depleted, and its economic system most sensitive to the supply disruptions, the campaign inevitably generates is one of the most reliably catastrophic patterns in the entire history of imperial overreach. It has appeared with mechanical regularity at the terminal phase of every major empire's strategic cycle, and it always produces the same outcome for the same reasons. Study Britain in 1956 with granular attention to the financial timeline, rather than the military and diplomatic narrative that dominates the history books. Britain launches the Suez operation in October 1956, with approximately $2.3 billion in gold and dollar reserves, already depleted by the post-war reconstruction costs and the Korea War, expenditures that had strained British finances for a decade. Within 6 weeks of the operation beginning, sterling comes under massive speculative pressure. The U.S. Treasury refuses to support the pound. The IMF loan that Britain requires to stabilize sterling comes with the explicit condition of military withdrawal. Britain's gold and dollar reserves fall by $279 million in a single month, more than 12% of total reserves in 30 days. The military operation was proceeding successfully. The financial operation was failing catastrophically. And the financial failure ended the military operation before the military objectives were achieved. Britain did not lose at Suez because its soldiers were inadequate or its military planning was flawed. Britain lost at Suez because it launched a weeks-long military campaign at a moment of financial vulnerability that it had systematically underestimated, against an adversary who understood that the financial vulnerability was the real target. Nasser did not need to defeat the British military. He needed to hold on long enough for the financial pressure on sterling to force a British withdrawal. He was right. It took 6 weeks. America in 2025 is launching a weeks-long military campaign with $34 trillion in national debt, $1 trillion in annual interest payments, a depleted Strategic Petroleum Reserve, a $2 trillion annual deficit, and an oil-sensitive domestic economy where every $10 increase in Brent crude adds approximately $25 billion annually to American consumer energy expenditure. The financial vulnerability profile is not identical to Britain in 1956. It is worse. Britain in 1956 at least had a balanced current account. America in 2025 runs a $1 trillion annual current account deficit that requires continuous foreign capital inflows to finance, foreign capital inflows that become less certain every day, that oil prices rise, inflation expectations increase, and the real return on dollar-denominated assets deteriorates relative to the alternatives that Russia, China, and their partners have been systematically building for a decade. The hidden financial force operating beneath the oil rally is not just supply disruption fear. It is the dawning institutional recognition that America is replicating the exact strategic mistake that ended British imperial primacy, launching a costly sustained military operation at the moment of maximum fiscal fragility, against an adversary whose most powerful weapon is not its military capability, but its ability to hold on long enough for the empire's own financial vulnerabilities to do the work that its missiles cannot. Iran does not need to defeat the American military. Iran needs to survive American strikes long enough for $150 oil to do what the Fatah II cannot: force a financial reckoning that makes continuation of the campaign politically and economically unsustainable inside the United States itself. This is the strategic calculation that Tehran has been running for 20 years. Not how to defeat America militarily, How to make defeating America financially rational for America's own creditors, its own bond markets, its own consumer class facing $6 gasoline. The empire's financial architecture is the target, the military campaign is the trigger, and the oil rally is the mechanism. Watch 5 financial signals in the next 30 days that will tell you whether this campaign follows the historical script or breaks the pattern for the first time in modern history. First, watch the 30-day Brent crude forward curve. If the forward curve shifts from backwardation, where near-term prices are higher than future prices, into contango, it means physical supply disruption has become so severe that buyers are paying premium prices for immediate delivery rather than future delivery. Contango in Brent during an active military campaign in the Gulf is the oil market's most explicit signal that supply disruption has become structural rather than speculative. Second, watch US inflation break-even rates on 5-year TIP securities. Every $10 sustained increase in Brent crude adds approximately 0.3 to 0.5 percentage points to core inflation over a 6-month lag. If Brent sustains above $120 for more than 2 weeks, the Federal Reserve faces the explicit choice between hiking rates into a war-driven recession or accepting inflation re-acceleration that destroys its credibility. Either choice is financially catastrophic. The TIPS break-even rate will tell you which catastrophe the bond market thinks is coming first. Third, watch the Saudi Riyal's forward rate in currency markets. The Riyal has been pegged to the dollar since 1986, one of the most durable currency pegs in modern financial history, maintained through oil revenue recycling into dollar assets that supports the peg's sustainability. If forward markets begin pricing any probability of Riyal devaluation, if the 12-month Riyal forward trades at a discount to the spot rate for the first time in decades, it signals that currency traders believe Saudi oil revenue disruption from the military campaign is severe enough to threaten the fiscal foundation of the peg itself. A Saudi Riyal devaluation would be the single most destabilizing event in the petrodollar architecture since Nixon closed the gold window in 1971. Fourth, watch Chinese Strategic Petroleum Reserve purchasing data from tanker tracking services. China has been quietly accumulating SPR reserves at a pace that accelerated significantly following the 2022 sanctions on Russian energy exports. If Chinese SPR tanker movements accelerate further during the American strike campaign, it signals that Beijing has concluded that prolonged Persian Gulf disruption is coming and is positioning accordingly. China stockpiling oil, while America depletes its SPR, is not a symmetric competition. It is a strategic preparation for an extended period of energy supply disruption that China's leadership believes will outlast America's financial capacity to manage. Fifth and most critically, watch the dollar index against the full basket of emerging market currencies simultaneously. Dollar strength against individual currencies can be explained by country-specific factors. Dollar weakness against the broad EM basket during an American military operation, the condition where the traditional safe haven dollar demand generated by geopolitical crisis is overwhelmed by dollar selling, driven by oil import cost inflation and current account deterioration in major dollar-dependent economies, is the signal that the petrodollar safe haven premium is finally being priced away. That signal has never appeared during a previous American Persian Gulf military operation. If it appears during this one, the financial architecture that has underwritten American global power for 50 years is not just being challenged, it is being repriced in real time by the market that ultimately determines whether financial architectures survive or collapse. Here is the final truth. The oil rally is not just a commodity price movement. It is a verdict. A verdict delivered by the most honest, most ruthless, most informationally efficient market that human civilization has ever created, the global physical energy market, on the sustainability of an empire conducting a weeks-long military campaign with a depleted strategic reserve, a $34 trillion debt load, and a financial system structurally dependent on the stability of the exact geography it is currently turning into an active war zone. Every empire that has ever reached this point has told itself the military campaign was necessary. Every empire was right. The campaigns were necessary. The question was never whether they were necessary. The question was whether the empire had the financial depth to absorb the cost of necessity, and the answer delivered not by historians but by oil markets, bond markets, currency markets, and gold markets operating in real time with perfect access to the same information the empire's own planners are working from, has been the same answer every single time. The empire always thinks it can afford what it cannot afford. And the market always knows the difference before the empire does. The oil rally continues. The strikes are just beginning. And the bill for both is already being written in markets that never lie and never wait for press conferences to tell them what they already know.